the best of Money Matters.
Market View on Money FM 89.3.
That's right. You're listening to Money FM 89.3, and it's now time for Market View, where we take a quick look at how the Singapore stock market closed for the day, the biggest movers, sectors, and companies to watch to help you better position your portfolios. I'm Alexandra Parada. The SAI closed up at 0.7% at 3,832 points. In the REIT space, Star Hill Global reported a slight rise in net property income, while Far East Hospitality Trust and First REIT posted declines, partly due to currency headwinds. Over in China, the official manufacturing PMI fell back into contraction at 49, raising concerns about demand and employment. Chinese bank earnings underwhelmed as net interest margins continued to shrink, and Chinese lenders now face added pressure amid slowing economic momentum and expectations of further monetary easing. Meanwhile, Chinese AI stocks surged after President Xi's visit to an AI hub, and attention is on U.S. tech, with the four of the Magnificent Seven, Microsoft, Apple, Meta, and Amazon, reporting earnings this week. Now, for more market moves and views, joining us today is Jeff Ang, Head of Asia Macro Strategy at Sumitomo Mitsui Banking Corporation. Hi, Jeff. Welcome to the show.
Hi, good evening, Alex. Thanks for having me for the call.
Thank you for joining us today. Okay, Jeff, let's start off with the STI. It opened at 3,811 points this morning. So what's your take on the movement so far? Were there any surprises or notable drivers behind today's performance?
I think overnight we have seen some slight recovery for the STI as well as regional stock bourses. The news was overnight news was that, the worst may be over for the US tariffs, with some potential sort of like reduction in the tariffs. I think both from US and China, there could be some potential reductions due to the fact that I think we are starting to see with such high tariffs, there could be some slowdown. So I think that's helping to boost a bit of the market sentiment overnight. Of course, now we are still in pretty fluid times. So I think this movements may also be short-lived as markets await more clarity on the global tariff situation.
I see. Now let's move over to the REIT sector. It has shown mixed results recently. Star Hill Global Real Estate Investment Trust reporting a modest 0.5% increase in net property income, while Far East Hospitality Trust saw an 8.3% drop in NPI. Additionally, First REIT recorded a 3.3% decline in distribution per unit for the first quarter in 2025, partly due to the depreciation of the rupiah and yen. Now, given these trends, how do you assess the outlook for the REIT sector, particularly for the hospitality-focused REITs? I mean, considering the challenges in international markets and currency headwinds.
Well, we're in quite turbulent times, isn't it? I think
yes.
What you have mentioned is that we are seeing continued headwinds for the real estate sector. Right now, we are past the peak of high interest rates environment. Some central banks have started cutting their interest rates. The Fed has already cut several times last year, although it hasn't done so this year, but it may do so later this year due to the fact that inflation may still be firm for now. But if it is heading lower, then the Fed may be more comfortable to cut policy rates. I think for the real estate sector, it's really sort of like two conflicting factors. Interest rates are lower, so helping to boost the profitability of the real estate sector. But at the same time, I think the global economy is also grappling with slowdown. And I think you also mentioned about depreciation of the rupiah as well as the yen. Mm-hmm. This year, we are seeing that the yen has rebounded quite strongly, but the rupiah is still quite hurt and still facing a lot of headwinds despite the US dollar. So I think currency fluctuations may continue to move this. Currently, the US dollar is weakening, so it means that these currencies may not have such headwinds anymore. So I think a lot will also depend on the real estate sector, which area is it, the currency and interest rate movements for those specific countries and areas.
Okay, now moving over to China, its official manufacturing PMI dropped to 49 in April, signaling a contraction. Now, how concerning is this data for China's broader economic outlook? And which sector will be most impacted by the slowdown? Do you foresee a ripple effect across the rest of Asia?
I think this is one of the first numbers that we are starting to see, because overall we haven't seen many April numbers yet. So the April China manufacturing PMI numbers is one of the first concrete numbers coming out after the sort of like tariff announcements post the US Liberation Day on 2nd of April. I think there are some signs that it could be worrying because it's the lowest since December 2023. So it's signaling that there has been some front-loading for the manufacturing sector. Previously, companies had ramped up production before that, but now perhaps they are using up some of the inventories and taking a bit of a wait and watch. And if you look at some of the breakdown, new export orders and prices were also down. So that is dragging on the overall value. So if you look at, for example, the silver linings on the other side, there could also be some potential that the government may step in to support. At the same time, when we look into the other Asia economies, there could be heightened competition with China exports as they look to divert their initial exports to the US, to other parts of the world, including Southeast Asia.
But given that China's manufacturing PMI has dropped, do you think there will be additional stimulus from the government to support its economic growth then?
I think it's certainly likely because we have seen that the government has been quite restrained in introducing a lot of stimulus. I think there's still plenty of firepower along the way. So if they want to boost economic growth, they can still do so to reach the around 5% GDP growth target. At the same time, I think they may also want to allow slightly slower growth as well if they want to. So it could be between 4 to 5% depending on how much official stimulus will be ramped up in the coming quarters. That could help to boost consumer spending or infrastructure spending as well. And I think if we look at some of the sort of like dollar CNY daily fixings for the time being, it's still been relatively flexible between 7.20 to 7.21. But as the dollar has weakened, the CNY is also looking quite weak compared to the other regional peers. So that may also be somewhat supportive of export growth to the rest of the region as well, due to the weak CNY compared to the rest of the Asian and other major currencies.
I see. But China's major lenders also reported declining profits and narrowing net interest margins in the first quarter. So what does this signal about the overall health of the sector, and how much further downside do you see for margins if monetary easing does persist?
Well, when I look at the macro data, I see that lending has been slightly better compared to a year ago, but nothing too spectacular compared to the past 5 years. It's relatively stable. So it does show that, for instance, there's some cautiousness for both the lenders as well as for businesses trying to take loans. I think with lower interest rates, of course, the margins may also be lower, so that may be a headwind and that may be a weak spot for the economy. I think any risk could also be contained because the positive part is that, or the silver lining could be that the China economy is still not totally open to the rest of the world, so any of the risks will more be domestic. And China do have the ammunition and the liquidity or the firepower available to support their domestic financial sector if needed.
But given its continued margin pressures and slowing economic momentum, do you actually see these Chinese banks shifting strategy to diversify their revenue streams?
I think it is possible because when I look into the macro aspect as well, if the China manufacturers do not have the US market and their own domestic market is still soft for the time being due to the weak consumer sentiment, albeit slightly improving, there could be more diversification ahead to the other parts of the world. We do see some of the China banks being situated around the world, so that could be a potential area where they can look to sort of like diversify and reduce their risk at this stage.
Now let's move over to the tech space. So Chinese AI stocks surged after President Xi Jinping's visit to an AI incubator in Shanghai. So do you see this as a shift in China's focus towards high-tech sectors like AI and robotics? And how do you think this will impact these industries in the coming months?
I think this could continue to be positives in the economy going forward. What we are starting to see is that all these technology products are gaining market share across the board. Perhaps 4 or 5 years ago, you may think that a China-made EV may not be market competitive, but now it's almost or the number one in certain countries or regions as well. So that could continue to be a trend in the coming months as they continue to have more innovation.
Now, still in the tech space, 4 of the Magnificent 7, Microsoft, Apple, Meta, and Amazon, are reporting earnings this week, with analysts expecting an average of 15% profit growth for the group in 2025. So what are you expecting from these results, and how critical are they in shaping the sentiment for the broader tech sector?
I think when I look at the overall tech sector going forward, there could be more competition. I think costs may be increasing, and at the same time, with a lot of uncertainty coming into the picture, there could be more headwinds ahead for this sector. Nonetheless, I think the outlook remains bright with the AI space looking quite positive. So there are opportunities for growth even within the competition, and perhaps the competition may also faster pace of innovation going forward. So of course, a lot depends on the multiplier effects of network. So some may win, some may lose. So I think there could be more to watch for going forward.
And before we let you go, anything else that you'll be looking forward to in the couple of days ahead?
Sure. In the U.S. macro space, I think what we are watching out for is the non-farm payrolls numbers, the U.S. labor market indices. I think they are likely to still hint at still tight and resilient labor market, but we are watching out for any signs of deterioration in the current print, as well as the coming few months as the tariffs are being raised, and there's some uncertainty that may creep into the labor market alongside potential curbs on immigration and other measures. At the same time, I think we're also watching out for trade negotiations between the U.S. and other economies. I think in the region, we also have several key data points as well. I think in the coming few weeks, we'll have more key India and China data that could point towards the April sort of like post-tariffs kind of environment. So this could be key to watch for how much damage the world economy is taking, or how much Asia is being hurt. And I think that could also shift policy expectations going forward.
Okay, well, thank you so much for joining us today, Jeff.
Thank you. My pleasure.
That was Jeff Ong, Head of Asia Macro Strategy at Sumitomo Mitsui Banking Corporation. This has been Market View on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.